When I first encountered Bitcoin, I was struck by how much it moves, sometimes jumping or plunging double digits overnight. In markets like stocks or commodities, momentum has long been recognized. Once an asset starts moving in a direction, there's a good chance it'll keep going for a while. But Bitcoin takes that effect to another level, partly because it trades around the clock and partly because the market is still relatively young and less crowded with institutional players. In real-world terms, that means when Bitcoin shows a strong trend, whether up or down, a well-designed momentum system can often capture significant gains, or avoid big losses. Personally, I find this very appealing because a momentum-based approach can be simpler to code and test compared with, say, complicated machine learning algorithms, yet it still offers robust performance if you manage it properly. Let me walk you through how I think about building a Bitcoin momentum strategy, starting with the basic distinction between time series momentum and cross-sectional momentum. When I say time series momentum, I mean looking at the price history of a single asset, Bitcoin in our case, and betting that if it's been rising, it will continue rising, at least for a while, and if it's been falling, it will likely keep falling. This is different from cross-sectional momentum, where you look at a set of assets, maybe the top 50 cryptocurrencies, and rank them by recent performance, then buy the best performers and short or avoid the worst performers. Since Bitcoin is roughly half the entire crypto market by capitalization, I found that, as a standalone asset, a time series approach is often enough. But if you're managing a basket of coins, cross-sectional momentum can boost your returns by giving you exposure to whichever coins are trending at a particular moment. In my own research, I came across a paper that compared a moving average crossover strategy on Bitcoin against a Bollinger Bands mean reversion approach over the period from 2016 to 2021. What stood out was that, once realistic transaction costs were included, the moving average, momentum, strategy not only held up but tended to outperform in most longer timeframes. In other words, buying when the shorter-term average crossed above the longer-term average, and selling when it crossed back below, yielded better risk-adjusted returns. I also read another study from a UK university that used intraday data to show that early morning volume spikes often predicted whether Bitcoin would close higher or lower by the end of the day. In practical terms, that means if heavy buying happens right after the Asian markets open, that momentum often carries through until the US markets open.